Hello everyone, Philip from BlackBull Markets here, another Whiteboard Wizards video. This one we're going to be looking at trading with chart patterns. So this is usually more for longer time frame trades, so your daily trades or your weekly time frame. So you tend to hold a trade for up to a week or sometimes even more, depending on what time frame you trade. But we'll look at the basic patterns, and what we have here are a couple to look at. We've got double tops or bottoms, we have head and shoulder patterns, retests, fairly simple as well. Triangles and wedges, which are quite similar to triangles, just we tend to expect a little bit of a different outcome from them. Starting off with the double tops, what we usually have is we have the market moving in a direction. For example, we'll do double bottoms now actually. Market moves in a downward trend. We hit a support, the market starts to retrace, and then we're looking for another push to the downside. Now, if this usually tends to be a very strong support, so it'll be like around a round number, for example. Round numbers again are, let's roughly say 1.300. This is a round number, so this tends to be nice strong support resistance areas, or in previous history it showed consolidation or resistance or support areas to the left of the chart. So that's why it's also important to keep an eye on the left side of your chart to see if there was any support resistance areas. But moving back to the pattern, now what we're looking for is a start to move in the opposite direction. You can, if you want to be more aggressive in your trading, already enter as it hits here. For example, you can put in the downward trend, for example, we can look to put let's maybe use a different color. We use the green here. We look to put either buy limit. So how a buy limit works, just to quickly take you through it, we set our buy limit, market comes down, hits that order and goes through again. So that's what we expect from a buy limit, and obvious opposite for a sell limit. Now don't mistake these for buy stops. A buy stop works a lot different. You have your order up here, the market just pushes through it and you get entered as the market pushes up. So do not mistake those, that will cause you some serious damage if you do. But coming back to this, so what we have now, we set our buy limit order, we see the market come down, it tests that. Don't forget about your stop losses as well, I'll show you where to put them a bit later. It hits that and it continues to the upside, and now we've successfully traded a double bottom. Now take profit, stop loss targets. Take profit, really simple. Now this is why it gets a little bit more difficult to use it with the buy limit. So if you want to be more conservative, that I would say would be the wiser idea, because you can manage your risk a lot better. So rather just enter once you see the market start to give you that look to turn around. Sort of again, candlestick patterns, or the market just starts to move in that direction again. Now once you've been entered, you can put your stop loss just below the zone, and then take profit targets. Usually you want to look for take profit targets here. What you can do is you can enter with multiple orders. So for example, if you were trading a one lot, you can maybe split this up into a 0.5 and a 0.5, right? And then what we can do here, we can put one take profit here, and then only close out that one trade, right? And we can let the other one run. Obviously, once it's surpassed your take profit here, we want to then move the stop loss in, so we make sure that we protect our capital, either to break even or even maybe a bit higher, so we can still secure some profit, just to protect your capital. We can let that one run until we maybe hit another resistance in this case, and then take the profit there. Or once we start to see some other patterns like the other ones, some of these that show other direction, that the market is ready to change direction, then we can look to take profit there. Now moving on to our retests now. Now retests are fairly simple, quite easy to go through. Again, now we'll use our market moving to the upside. So we have our price, time frame, we see the market move, we made that high, we see a coming back down. And now this is a failed double bottom or failed double top in this case as well. What we can use, the market breaks above, and what we're looking for now is, a lot of new traders tend to enter here. We don't want this. This is where you can get burnt. So what we're looking for to be safe, the market moves up and we're waiting for a retest of the zone, because now we had that resistance turn to support on the side. Hopefully we have a retest and we can again enter here, putting our stop loss just below here once the market starts to give us that direction. Enter when the market shows us that it's ready to commit to the move, and then we can obviously stop loss, buy here, and then obviously take profits. We could possibly look to the left for potential take profit areas. We can again use that simple concept where you break the trade up into smaller trades to take partial profits, manage your risk a bit different. So that's your retest, obviously vice versa for a downtrending market. Moving on to our triangles. We have three variations of triangles, and depending on what triangles we have, we can see different outcomes, or we expect different outcomes. What we have, for again example, this can be an uptrending or downtrending market. We have the market start to move in a consolidating price range. This can be uptrend, or like I said, it can be downtrend as well. We're expecting either outcome for this. So we have the market moving in this triangle pattern. Now what we're looking for is a potential break either to the down or to the upside. Very easy, very simple. If it breaks to the upside, stop loss below here. Breaks to the downside, stop loss above here. Right? Fairly easy, fairly simple. Now variations of these triangles. First one we're looking at is the flat top triangle. So we have price again consolidating tighter and squeezing tighter into a zone, right? But the only difference is now this line up here is flat, and this one goes to the upside. So it still shows that although we have a resistance forming, we still have higher lows. And this also still indicates a trending market. Higher lows for upside and vice versa for the downside. So we're still expecting a push to the upside because the market is still giving us the move to the upside. We're looking for a break. Again, we can use that retest to be more secure. So break to the upside, retest, enter, up, stop loss below here, and again vice versa for the downtrending market. Now what we have now is a flat bottom triangle, very similar thing. I'll draw it, but it's pretty much the exact same thing. You can have an uptrending or downtrending market. Market moves. We have the flat bottom, and the price coming down. So now what we have here are lower highs at the bottom, right? So these are lower highs. So it still shows strength to the downside of the market. And then what we're waiting for is that break, hopefully a retest. If you did miss the move, this is to be safe. Stop loss below here, and then we can look for the markets moving down, depending on where you want to put your take profits. That is completely up to your appetite. And now wedges. Wedges are very similar to triangles. They just form a little bit different. So again, I'll use uptrending market for this example. We have the market coming to the upside, and again, market starts to squeeze into a price. And we have that wedge shape forming. So this is what we call the wedge. We have the market consolidating between these two prices, and we're waiting for a pop. Now usually this shows over here, this shows exhaustion in the market. And what you usually have, if you do like to use indicators, for example your RSI or your MACD, they will show a divergence. Now what we call divergence in here is we will have the market moving with a MACD, and the MACD makes a high form, or your RSI, and it does this. So what we have here is we have what we call divergence. We have a trend line to the upside over here, and here we have a trend line to the downside. This shows again possible moves. We're looking for a push to the downside. Now keeping in mind this move could not be fluid, as we do have support zones coming up that we could look for now, but these can also play as a potential take profit target. Usually if we see a wedge, we'll see the move take this whole pattern out, and this could be an overall take profit. Now once it reaches here, don't be greedy, look to close your trades and take what the market gives you. Never take more than what the market offers, because then is what we will usually have is we'll have this, and it'll reverse all the way and you'll give all your profits back to the market. Now vice versa for a normal trade, for a downward trending market, obviously this is just flipped around, plays the same way. It's very rare that we see a move to the upside, but if we do, it tends to be a lot cleaner, but we do expect the move to the downside to be more prominent in this pattern. So fairly simple, head and shoulders. Well, let's work on that one quickly. Almost forgot. quickly head and shoulders. So I'll do this in an uptrending market as well to make it a bit more easier. So we have the market coming to the upside, retraces, breaks past, retraces. This is the move we're looking for, right? So this is essentially the pattern what we're looking for, right? So we have our left shoulder, right shoulder, our head, and our neckline, right? This is usually the target we're looking for when we do trade head and shoulders. But we can, like I said, split that trade up to look for more opportunity in the markets once we moved our take profit in. So to play this, we have two different ways that I like to play the head and shoulders pattern. And this is once it's passed. We can do 3 different plays if you want to trade with a trend and be safe. We can look once it reaches this neckline. We can again look for a buy to the upside, stop loss just below that neckline, depending on rejections. And then obviously we can look for, once we notice this and we see the market start to slow down around this area where this previous shoulder was, we can look to take profit there. Now you can actually place a reverse trade, right? So now the market has reached up to your shoulder mark. You see, okay, so we see a head and shoulders form. Now we take a sell to the downside, take profit just above that. I usually put it just above this. If this one's a bit higher, we have to play it a bit differently, look at what the market gives you. But usually this is same level or even lower. And then we can look to put our take profit down here, right? And then obviously if we split that trade once it breaks past, you can look to take profit, move your stop loss into break even, and now we're playing a risk-free trade. Well, this is actually, if you put it here, you've made some profit, you locked in some more profit, so now, like I said, risk-free trade, you're playing with the market's money, and you can decide when to exit. Fairly simple, vice versa for the other one. Easy to play. Enjoy it. From everyone here at BlackBull Market Safe Trading. Make sure to give us that like button, click the subscribe button, followed by the bell icon to get our new notifications of new videos. Thank you very much again for watching. Stay tuned.